Hi, I'm here today with Gary, our mortgage broker. And what we're going to talk about today is mortgage protection. And the reason why mortgage protection is really important is we're all about generating long-term wealth. But how do you keep that wealth into the future? And that's where mortgage protection comes into play. So Gary, what is mortgage protection and why is it so important?
So basically, mortgage protection is, you would have probably heard about it, sort of called term assurance. So protects the person who takes out the loans on the mortgage in the event of death, premature death. So if it's a couple, say for instance, and you've got one partner dies suddenly during the mortgage term, then the IGR, the mortgage protection, the mortgage term assurance will pay off the remaining part of the loan so that the surviving partner doesn't carry the debt forward with themselves.
But why? So Gary, why would I worry about that? So say, for example, I own a portfolio of 10 properties. There's a decent amount of equity in there. All the mortgages say are in mine and my missus' name or just my name. So why would it be important for me to have mortgage protection? What would be the reason for that?
The reason being, basically, if you die, Nigel, and most of the mortgages were just in your name, the lender, once they were informed that you had died, then they would be coming knocking on your door saying, we want these mortgage loans paid for. Now, in a buoyant market, which we're seeing today, then you could easily, your partner, your surviving wife or whoever, husband, they could basically say, right, it's a buoyant market, we're going to sell these properties, we've got a little bit of leeway, we can manage the mortgage payments at this moment in time, then we'll sell them and we'll get rid of the debt. If it's a slow market or you cannot sell them, then you're left with the debt, and the lenders have the right to basically say, right, Nigel, you've died, but your wife isn't on the mortgage. We need to basically assess her affordability. She can't just automatically go on that mortgage. She would be assessed. She'll have to do a new application. Does she fit the lender criteria? So all of a sudden, there's a spanner in the works. So with life insurance, that takes care of that, Nigel, because you get the life insurance for the term of how much debt you've actually got. Then you die, unfortunately. It gets passed to the wife or partner. We'll put it in trust so there's no inheritance tax liabilities and things like that. Then it just makes sure that they've got a lump sum to do whatever they want, but ideally to pay the mortgage loans off. So then they can basically live mortgage-free, debt-free, and all your hard work that you've built, done like the sort of build up and all the residual income and everything, they can live on it. And you know fine well, you've left your partner and your children financially sound.
Yeah, I mean, I've been through this process, Gary, where I've actually got a decent size a life insurance policy for my property, and the reason why I came into it is actually just for simplicity as well, because after, if unfortunately I did die early and my partner inherited all my properties and obviously my children as well, then I wanted it to be as simple as possible, not having to negotiate with the lenders, sort out all that lending piece. She'll end up with a load of unencumbered assets where it's very simple. And at that point, because there's no mortgage debt, doesn't really matter how much equity is in there or not. At one point, she can sell because there'll be plenty of equity in there. And also the lender issue disappears. So it becomes incredibly simple as well. So it's definitely
simple, yeah, definitely.
Yeah.
Nothing similar, and it just basically you're leaving your partner or your wife or husband your assets, what you've worked hard to build for, and so they're not sort of having to sell them and basically starting again.
Yeah, no, I totally, and it's something which it took me a few years to sort out. And actually, you'll probably say this: it's better to start earlier because obviously you're further away from dying. So I mean, how do you find premiums are affected by age anyway?
Well, the younger you are, obviously premiums are a lot cheaper. If non-smoker, again, a lot cheaper. The older you get, and if you've got any health or medical conditions, then obviously the premiums will be affected. The term will also have an impact. So generally, you can get life insurance cheap as anything, Nigel, like as a basic package when you're young. So yeah, it's not fortunes, but as you build a portfolio, then obviously it does get more expensive as the more portfolio you build, the larger the loan amount and everything.
Yeah. No, I mean, I think I got my life insurance policy about 10 to 12 years ago, and I'm sure it'd be incredibly more expensive.
Yeah, definitely.
From when I started, I had to have a medical and stuff.
Yeah. And there's nothing wrong if somebody's saying, right, my ambition is to grow my portfolio X, Y, Z, put some of the life insurance in now, even if they haven't got to there, because they're still trying to achieve the dream of like becoming £1 million property portfolio owner. So there's nothing wrong with getting a £500,000, £1 million life insurance policy when they're young, take it over an extended period of time. The premiums are guaranteed, so they're not going to change over the 10, 15, 25, 30-year term. Then build a portfolio in the background rather than doing a little bit of life insurance. Then build your portfolio. Then 10 years later, you've achieved the £1 million portfolio, say, but you might have been diagnosed with something in between then. So all of a sudden, you can't get life insurance or your premiums went up. So just take advantage of it now. The younger you are and the healthier you are, then get it in place now.
I think it's the greatest way to protect what you've built for your loved ones. It's something which, I know that, if I did die, that what I built would still be in place beyond my death. And that's not because I just want to build something. It's more I just want to make sure my kids and my missus is looked after. Really.
Financially sorted, yeah, and the financially sound. And not just that as well. What a lot of landlords forget is that building a portfolio that might be sitting on a lot of equity, then we're not going to go into it too much today, but they could have an inheritance tax liability. So all of a sudden, they're going to be hit with a 40%. You've worked hard, you've paid tax all your life, then all of a sudden you die, and your partner, because it's not being put in trust or it's not being like things on joint, then you could all of a sudden have this inheritance tax liability and you're going to be paying 40% tax on anything which is over the IHT threshold. So all of a sudden, you've just got this massive bill, and when the taxman comes looking for you, they're not going to say, oh, wait until you sell a couple of these properties, they're going to be wanting their 40%.
Yeah, no, actually that piece I think is really important, and that's why you shouldn't just really get, especially if you're dealing with large amounts of money and you're above the inheritance tax threshold, is what you should do is chat to a mortgage advisor or somebody who can give you professional advice, because writing life insurance policies into trust are dead easy. Yeah. It gets out of a lot of inheritance tax bills, getting plenty of cover for the actual inheritance tax bill you will incur, because there's two elements to actually just thinking about it. Is one, the receipt of money you receive from the life insurance policy. If you put it into trust, then it becomes outside the scope of an inheritance tax. But there is an inheritance tax from the inbuilt equity you get, and you can get a life insurance policy to pay for that as well. So these are the type of questions you need to chat to a professional advisor to help you with. And in terms of other things which might affect your life, Gary, I've got a couple of things which I've heard of. Critical illness, income protection, family income benefit. What are those, Gary?
Yeah, so right. So people just think about dying, term assurance, but statistically they're saying now 1 in 2 people before they retire will actually end up being diagnosed with a specified critical illness. That could have a heart attack, a cancer, there's about 36, 40 odd different conditions depending which provider it is. And a lot of people now with medical science are surviving, Nigel. So we've had clients in the past who have been in the 30s and 40s, been diagnosed with a cancer, they've had a heart attack, they've been at the Freeman Hospital in Newcastle, fantastic job, stents in, 1 or 2 stents in, they went back to work within a month, 2 months, and because they've listened to it and they've took our advice, they've actually had a lump sum paid to them through the critical illness policy. It's paid off their mortgage, then they've been able to go back to work. And some people have said, right, I'm not going to go back to my job full time, it's too stressful, my mortgage is paid off, I'm actually just going to either have a change of career or I'm only going to work 3 days a week to suit my needs and my lifestyle now. So it just gives them that sort of financial freedom. With income protection, it's a policy where basically it insures your income, Nigel. And you know, the silly thing, what frustrates me so much when we're doing this and talking to people insure the cars, they insure the houses, they'll insure the iPhones or whatever mobile phone, tablets, washing machines. Then you see it, and you insure your income. No, what you actually get from the sort of your work, and a lot of people don't know. Some people say, well, I might get a month, I might get 2 months. And we'll just basically say, well, what happens if you basically lose your income? Do you know how you're going to survive? In Nigel, if they qualify for SSP, which is a statutory sick pay, then entitled it's about £96.35 a week for up to 28 weeks. I'm sorry, but that's not going to get you anything in this day and age. And we say to clients, the first thing you should do is protect your income in the event of long-term illness, accident or sickness, because you don't know what's going to happen to you. I think this last 18 months has shown people exactly things can happen all of it suddenly, which like nobody's expected, and basically protect your income. If you haven't got your income, Nigel, you haven't got anything. And I refer to clients and say to them, you're buying this lovely house, it's XYZ, it's going to be £1,000 a month, £500 a month mortgage. You lose your income. We've just told you you can only get £96.35.
Yeah.
Would you buy a house with no foundations? Like, you know, would you, like a builder, build a property with no foundations? What would happen? It would crumble. So why not protect your income? Because if you haven't got an income, Nigel, you've got nothing.
Yeah.
You can't go out and buy your car, you can't go and pay your mortgage, you can't do the shopping, you can't do anything. So people should actually be looking at protecting their income in the event of long-term sickness, long-term accident, and just basically making sure they're bulletproof. And your last question, family income benefit, that's a sort of, again, it's a term assurance when somebody dies, and it provides like a monthly income for them, Nigel. So it might relate to somebody who maybe hasn't managed a great deal of lump sum, or they mightn't be very good with managing a lump sum, and they just want a regular income when the children are sort of young. Maybe they might have children, say 2 to 4 years old. The partner, who's the main earner, might die. Put a little family income benefit policy in place until the children are, say, 18, 21, until they're dependent. Then it just gives the surviving partner maybe a monthly income of £1,000, £1,500. It's not that expensive. It's pretty cheap, realistically speaking, just to give them that sort of bolt on that they're going to get sort of an additional income. So they don't have to sell the house, they don't have to change schools, or they've got all the still the financial aspirations for the children that can be met at a later date.
Yeah, no, that's really important as well, just to make sure. So you can have different types of insurances just to provide a different outcome depending on your circumstances. So I was chatting earlier with you, Gary, about, because it's all well and good, you know, we need to know a few tricks about these things. So in terms of life insurance policies, is there any way I could make that a business cost? So effectively, I'm paying, it becomes tax deductible, so it effectively costs me less. Is there any way of doing that?
Yeah. So what the providers came out with a number of years ago is what they call irrelevant life insurance policy. Now, if you own a limited company and you're a company director, then you can basically take out one of these life insurance policies. It's a term assurance policy, Nigel, a life insurance policy. And what happens is, just imagine it's like a death and service policy. So you basically take an insurance policy out, more or less always written in trust. So what happens is the company pays for the policy, you put it in a trust for your beneficiaries, so your wife and children will actually receive the lump sum if anything happens to you. Now, these, with the majority of cases, are tax deductible. They're not classed as a benefit in kind, so you're not going to be paying national insurance or tax on the premiums, and you can basically offset it against your corporation tax, Nigel. And because the lump sum that you insure yourself for is in a trust, then they become tax-free as well. So they come out of your estate, so you've got no sort of tax liability, anything like that for yourself. So your family receive that money tax-free.
Yeah, that's really, well, that's really useful to know anyway, Gary. That's really useful. So I mean, just in terms of ballpark figures, I'll talk from my experience. So of the properties I own, I pay about £3 to £5 a month for life insurance, which will cover the entire mortgage. So typically the properties I own are around 100 grand, say. So there's probably £100,000 worth of cover for that £3 to £5. Typically, I'd say buildings insurance is what, £10 to £15 a month. So really, if you're looking to provide that security for your own death, as well as something which may happen to your property as well, such as the biggest one's fire, you know, that's the biggest damage you can get, you're probably looking to increase your overall insurance burden by £3 to £5 per month, which, if you look at it from an investment perspective and building a business and building a legacy, and also generating that long-term wealth and protecting that long-term wealth, then it isn't a large cost, and it's something which I've definitely taken on board. And really what I probably recommend is to chat to somebody like Gary about this, so you can just go through the numbers, go through the scenarios, go through the reasons for it, and if it is something which you believe will help your family and any loved ones, if unfortunately something happens, I definitely recommend it to people. I mean, have you got anything else to say, Gary? Really?
I would just point out that basically we'll offer a free review, as you know, Nigel. We do offer estate planning, which obviously includes wills and trusts, just because working with yourselves, we know people are trying to build wealth, and it's our job also to protect that wealth and making sure, yes, you pay your taxes in your lifetime, but when you die, you don't want to be paying minimum taxes for the surviving partners and the surviving families and everything. So give us a shout, and basically we'll help you mitigate any sort of tax liability you potentially could have, and just making sure that your families are covered and protected, Nigel.
Yeah, I mean, the one thing I would say about the tax planning within this is it's all very simplistic. We're not trying to reinvent the wheel on all this. This putting stuff into trusts and stuff is something any solicitor could do. And to be honest, I didn't even go to a solicitor. All I had to do was fill in a form with a life insurance company and say I'd put it into trust. And I think I got a little bit of advice about that just to make sure I'd done it correctly. So all of this is just incredibly simple, but like anything, you just need that knowledge, and the best way to get that's from an expert, just to help you in the next stage of your investment portfolio.
And making sure you've got the right policy in place, Nigel, instead of wasting your money. We've been to clients and spoke to them, and they've got this plan or they've got that plan, and you look at it and you think, sometimes these plans aren't worth the paper they're wrote on, because they're not right for that client. They've been on comparison sites and pressed a button because they're thinking they're getting it cheap, but it's not right for them. The conditions, the companies they've used, whereas we use 5-star companies who offer basically the best sort of policies with the best payouts.
Yeah, no, that's really good to hear. Anyway, so Gary, so what I'd recommend to anyone, if you have watched this video and you've found it quite interesting, is to email ourselves at landlords@nguhomelatings.com. And what we'll do is forward your details to Gary, and Gary will try and help you with any of these issues regarding life assurance, critical illness, all these things which may be useful in the event of death or an illness. So thank you so much for your time, Gary, and we'll speak in about a month's time.
Yeah, thank you, Nigel.
Okay.